Good afternoon, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our Sunday webinar. Thank you all for joining us today, and I hope you're all enjoying your weekend. And today's class is going to be about technical indicators with a little bit of a focus on Gann Fans and some other indicators. Now, for those of you joining us for the first time, ETX is a regulated provider, so therefore I'm required to give you what's called a risk warning. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds you cannot afford to lose, and seek advice if you do not understand the risks. All information that is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned tonight are for educational purposes only. Now, for those of you that are joining us through the internet and don't know much about ETX and not part of the ETX family yet, we are a fast-growing financial services company, and we are based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we are a member firm of the London Stock Exchange. Now, when you join ETX, you can trade with our MetaTrader 4 platform, our Trader Pro web trader, to trade currencies, commodities, stocks, and indices. If you're in the UK, you can spread bet, you can trade CFDs elsewhere, you can also trade Forex and futures, or you can trade binary options with us. So give ETX a shot. Now, today's class is trading with Gann Fans and other indicators. And we're going to be talking about what is called technical analysis. Now, technical analysis is a method of evaluating securities by analyzing statistics generated by market activity. If you've ever bought an asset, a bond, a mutual fund, only to watch it go down and then vowed to sell it once you broke even, you might have benefited from learning more about how technical analysis evaluates the markets. A technician looks to take the emotions out of investing by applying rules that usually apply to almost every investment that fluctuates in price in the free markets. Now, a fundamental analyst looks at economic trends of a company or a country and derives an estimate of a fair value of the asset. If the asset's priced lower than expected, he would buy the asset. If the asset's priced higher, he would sell the asset. A fundamental analyst than what the fundamental analyst believes it's worth. The problem with focusing on only valuations is that overvalued assets can get more overvalued and undervalued assets can get more undervalued. Now, the thing about it is you can trade using any method you wish, but there are very few ways that you can establish entry points, exit points, stop loss points, swings of the market, and do proper risk management without using price action on a chart. Because using an economic event, such as the U.S. raising rates last week, can tell you, yes, gold should go up and the dollar, or gold should go down, the dollar should go up, but exactly the opposite happened last week. But at the same time, how do you know how far gold should drop? How do you know when it's falling, when the Feds make their decision, where it should fall to? And where would you put your take profit point? How would you set your target if you're not looking at price action on a chart? So very often, technical analysts will skip analyzing an asset's prospects and values and assume the market is doing that for them because an asset's price reflects everything already publicly known and expected about the company or the country or the asset and its prospects. Technical analysis instead seeks to focus future price of investments and markets by analyzing price past trading action. In other words, using a chart, price patterns on charts. In general, a technician believes that people have predictable mental shortcuts of reacting to the action in the markets. A technician seeks to profit by anticipating the mass psychological bias of buyers and sellers in a broad range of markets. And again, the perfect example was last week's Federal Reserve meeting. If you looked at the textbook explanation of whenever the Federal Reserve raises its rates or whenever a central bank increases its lending rate, it should send that country's currency up and reduce risk assets, because when the central bank raises rates, they're telling you in essence the economy is doing well, and they're doing it to slow inflation, and so therefore it has an effect on gold. And by raising rates, the country's currency has more value because you have more flow of foreign investments, because wherever rates are higher, you have this flow. So therefore, the dollar should have increased last week. Gold should have fallen. What happened was the markets were already expecting all this, and it was already priced in way ahead of time. So what we saw was a bigger reaction to what the words that were coming from Janet Yellen's mouth, and we saw gold rise, and we saw the dollar fall, exactly what you would have expected, the reverse of what you would have expected happen. But those traders that were trading with technical analysis had already seen this. They had already predicted it, and they were in the right side of the trade. But also, if you were trading thinking the dollar would go up farther based on this rate increase, you would have had to know where to put your stop loss. So when the dollar started to tank, you could have exited the market with a minimal loss. But this would not have appeared in your estimates because you don't have no idea what the level is that it would fall to, or where it would bounce, or where its volatility would have been. So despite all the fancy and exotic tools it employs, technical analysis really just studies supply and demand in the market in an attempt to determine what direction or trend will continue in the future. In other words, technical analysis attempts to understand the emotions in the marketplace by studying the market itself as opposed to its components. If you understand the benefits and limitations of technical analysis, it can give you a new set of tools and skills that will enable you to be a better trader or investor. Now, technical analysis is a method of evaluating assets by analyzing statistics generated by market activity. Technical analysts do not attempt to measure a security's intrinsic value, but instead uses charts and other tools to identify patterns that can suggest future activity. So in other words, if you were looking at Apple, or say you were looking at Snapchat or Snap last week, or the week before when it rolled out in public, okay, if you're looking at a technical analyst doesn't look to evaluate the stock. They don't pull it apart and see what it's worth, what the company's worth, what its future sales are going to be. That's fundamental analysis. They don't care about the IPO. They don't care about, how many subscribers they have and how much direct. What they care about is it the price it is today is not the price from what the price point it is now. Is it going to go up or go down? If it's going to move up, where should we expect it to move to? So it's not concerned with the actual value of the asset. So the field of technical analysis uses three basic assumptions. The market discounts everything, price moves and trends, and history tends to repeat itself. Now, for our evaluation today, we're more concerned with number 2 and number 3. The markets follow trends. Now, if you don't understand a trend, and you don't understand the basics of trends and support and resistance, we have 2 other classes for you. We have the trends as your friend, and a class that's called support and resistance. We have both of them coming up on next month's schedule. We might even have one of them scheduled this month. Go look on the ETX calendar. But you have to have a general assumption for all of this before you can start applying technical analysis or technical indicators to your chart, because technical indicators such as Gann Fans, such as Fibonacci, such as MACD, RSI, stochastics, they are secondary to your primary determinations. Nobody should be using an indicator for a primary trading decision. You should be using charts, patterns on charts, trend lines, and support and resistance lines. Okay. Now, when you start using an indicator, you need to figure out what you want it to do for you, because there is no one catch-all remedy for the whole market with one indicator. And too many traders try, oh, my buddy told me about this with stochastic, or I could do this with RSI, and think that they can make their whole trading decisions based on one indicator. But indicators are, number one, secondary or supportive decisions. Okay, they are not your primary and should not be your primary trading method or trading decision maker. Now, when you stop to decide what you want an indicator to provide for you, you have to break it down into several things, what you want to accomplish. Do you want an indicator that's going to give you trading signals? Do you want an indicator that's going to give you entry points? Or do you want one that will just give you exit points? Do you want one that will show you where to put your stop loss level? Because not all indicators will do this. Okay, like Bollinger Bands will show you the volatility in the market. They'll also show you where you should put your extra exit and entry points, and they'll show you the swing of the marketplace. Because when you put your stop loss, you have to be able to cover that swing of the marketplace. Where RSI and stochastics really tell you if the trend is overbought and oversold. They virtually do not give you entry or exit points for a marketplace. Now, MACD gives you excellent indicators for entry points. So you have to understand or determine what you want from your indicator. Too many people use generalities, and they say, I'm going to trade this asset when this happens, but they're using it for everything. Overbought and oversold indicators don't give you much of anything. So people that swear by RSI and stochastics are making serious mistakes. They're not successful traders because RSI and stochastics are what we call lagging indicators. Okay, and they are bounded indicators. They tell you when the price has reached a point of, say, oversaturation, but an oversold or overbought asset can still continue in that direction. It just gives you a warning, so it's giving you informational pieces. So the first thing you have to start out with is by placing support and resistance on your chart. Okay, now support and resistance come from many places, but support and resistance will be the first piece of information you want to put on a chart after you set up your chart and determine the trend. So regardless of what time frame you use, whether it's a 1 minute or a weekly, you want to see where the price has moved up, hit a resistance level and reversed from or bounce down to, or hit a support level. These are very basic ideas of support and resistance. So if you don't know how to find support and resistance, you can follow these steps. Okay. Now, we're going to use for this case what I call eyeballing. Because there are many, many, many ways and many indicators that will give you support and resistance level. But if you think of support and resistance as the prices above and below the current price where the traders in the past have hemmed and hawed, or think of price as an elevator, and these are the floors that the elevator tends to stop at often. Or there's simply the peaks and the valleys generated by market activity. There are many of these. There is not one. Nobody is going to tell you there's only one support level. You can have many, many, many support levels on your charts. When I first started trading, there weren't computers available to us. There wasn't any historical data. All of our data was on these mile-long charts that we would be drawing on graph paper that you'd pull out. And we would eyeball these levels. By eyeballing, we could look at a price on a chart and see over the past, whether it's a month, 2 months, we can go back 6 months on the chart, we go back a year, where price had hemmed and hawed. Now, support and resistance is more valuable when it is more recent. But when you can't find recent support and resistance levels, you can go back as far as you want. You can go back 10 years, you can go back 20 years. But the farther back you go, the less value it has. So let's go look at a real chart and let's go see if we can eyeball some support and resistance. So let me pop up a chart on your screen. Okay, so we're looking at the Euro US dollar, and let's go look at it in a 30-minute chart. Now we can see the euro has been moving up. The euro has moved up against the weakness in the dollar since last Wednesday, and the first levels of support and resistance we would like to look at is where the price is currently trading. So we can eyeball on this chart. And can we see some significant price range? Well, we see lots of, we see lots of, come on, hold on, there we go. We see lots of significance at this one price up. We see a top here, we see an open here, we see down, several days later, we see a close there, we see a close. We can see that this 107, hold on a second. Come on. We can see that this 107, 460, 446 is a significant level in past trading ranges. Okay, we can see tops, bottoms, closes, opens to that level. Okay. It's not telling you much of anything, but it's been important to traders over the last few days. We can also see other levels, and these are just eyeballing it. Okay, that is an important level. Okay. How important these levels are is hard to tell at this moment. But look at that. When we come down here to the 107.306, we said this is a crucially important level. Look at all of those highs, lows, and opens, closes that touched that price and bounced off of it, whether it bounced above or below. But this is only the most recent. It happens to be because we saw the euro take a big jump. Now, if we pull our charts back a little bit farther, because we want to look to see if we can see the euro trading at this level in the recent past, and we don't. We see the euro has been much lower than that for the last few months. So we haven't even seen it. Ooh, there we go. I'm sorry, sometimes the computer programs and the charts conflict with each other because of the software we use to give the presentation, but we're all right. Okay, so we can go back, and we're going to leave these lines in here. We're going to go back to a one-day chart so we can see this asset over a longer period of time. And we can see that it really hasn't been trading at this level in quite a long time. We can see it broke down below this, and then we see no price action at all in between this 108.42 and this 107, what is it, 107.65. Okay. So we can go back from here, we can go back and look at a 1 week chart. Okay, on a 1 week chart, we can see some other levels that are important. But see, it's staying below, but we can put a line on here. Okay. And all we're trying to do is get some levels that might be important to price. Because the first way is to eyeball. There are many other ways to get support and resistance. We can get them from Fibonacci levels. We can get them from pivot points. We're going to get them from Gann Fans. And the reason we're really talking about this is because we want to get over to Gann indicators. But you need to have some understanding of what the pivot points are and where to start with. I mean, what the support and resistance are and where you start with. Okay. You can get them from other ways. We could go over to investing.com. And we can go up to the tech, we can look, we're looking at the euro US dollar, so we can look at the euro US dollar, and we can come over here to the technical analysis, and we can get them right here from the pivot point charts. And we can also draw these levels of support and resistance on our chart. So we have 107.37 and let me write these down, let me put them on chart. We have 107.37. $107.37, and we're just going to take one above and below, and 107.47, and we're going to go put these on our chart. So look at this, we eyeballed it, and what do we eyeball it? Right at 104.47. We have the second purple line, and we have another eyeball at 107.37. So we're going to put this on, and we're going to make this one red. 107.37. So now we have the red line. That comes from the pivot points. All that these support and resistance lines do is try to give you some indication of where you might expect some type of price action and reaction when price is moving. That's it. Okay. We're not making any trading decisions based on these yet. So that's why eyeballing works great. And I love eyeballing. I mean, like I said, it is my favorite way of doing my support and resistance because it gives me my own personal intake and a better understanding of what my levels should be as opposed to using pivot points or calculations. So now we have these calculations and we have the beginnings of a chart. We haven't put a trend line on here, but let's quickly draw a trend line on here. All right, so now we have a trend line. We have, actually, it's an active trend line because we have 1, 2, 3 points in common, so it's actually a valid trend line. Actually, it isn't. Okay, so there we go. We have our trend line. Okay. So we have the basics of a chart and some information. So now let's talk about how we could put other things on the chart that might help us make trading decisions. Now, because for class I'm doing this rather quickly, you have to be a little bit more detailed. It happens to be my trend line fell on beautifully, but our support and resistance we have to do a little bit more studying on, but we have to go through the class pretty quickly here. So let's go back to my PowerPoint. And many traders consider price action to have special relevance when identifying support and resistance for one very compelling reason. The market has actually traded this asset at those specific levels. And that's why we look for support and resistance levels that are more focused on where you're looking at and where the asset is currently trading. Now, the more times that this asset has touched that level, the better or the more supportive it's thought to be. Now, which element of support and resistance works best? Well, it depends on your strategy. None of the aforementioned support and resistance levels have any predictive behavior. Each is simply a probability that we won't be able to determine until a trade is over. But these levels can help traders build their approach to work with those probabilities, looking to limit risk while maximizing gains. So the meat of the strategy is still very much going to be based on your other risk management because of the single unifying fact that you will never know what the next candle on a chart will be. So when you start building your charts, you want to have indicators that fit your requirements. Okay. Some of these need to be what fall in the category of predictive. Okay. There are very few indicators that help predict where the market will be moving forward. Most of them fall under the category of leading or lagging indicators. Okay. Some leading indicators will give you an entry signal, but very few tell you where the market should be later today or tomorrow or next week. They don't have a prediction. They don't have a future outlook on the markets. Fibonacci levels help you see where a price should act and react to, but they don't tell you in time and space. They only tell you on price movement, where some give you a predictive nature. And Gann Fans falls in this category of predictive quality. Gann Fans have been used by active traders for decades, and even though the futures and stock market have changed considerably, they still remain a popular method of analyzing an asset's direction. New trading areas such as foreign exchange markets and the invention of ETFs has also made it necessary to revisit some of the construction rules and application concepts. Although the basic construction of Gann angles remains the same, today we're going to talk about how to apply these Gann Fann indicators in the Forex currency markets. Okay. Forex traders who are new to Gann theory often ask which angles are most important in predicting price-time movements. The answer depends on the particular market. Finding the most effective ratio is a subjective exercise. Gann angles and indicators are counterintuitive to the proponents for efficient market hypothesis, which holds that past price moves cannot accurately predict future price moves. In fact, Gann theory offers winning predictive tools for traders experienced in their use. The short explanation about why Gann theory works is that when uptrending markets reverse and then breach and fall below the nearby ascending triangles, those prices usually then drop down to the next closest angle. Likewise, when downtrending prices reverse direction and then breach upward through the nearby descending angles, those prices will tend to move upward and achieve the price level of the next closest angle above them. Right? That sounds like a lot of mumbo jumbo, lots of words. Yeah, it's pretty kind of confusing. Understanding Gann Fans, not using them, but understanding the theory behind them is it's like trying to understand a science fiction movie when they're trying to talk about timelines and time movement and talking to you about, time being relative flat and there's 1 dimension, 2 dimensions, 3 dimensions. It's all very complicated to us normal brain people. Now, Gann angles are a popular analysis and trading tool that are used to measure key elements such as pattern, price, and time. And this is where it gets confusing because it measures time. The often debated topic of discussion among technical analysis is that the past, the present, and the future all exist at the same time on a Gann angle. Doesn't that sound like something from Star Trek? When analyzing or trading the course of a particular market, the analyst or the trader tries to get an idea of where the market has been, where it is in relationship to the former bottoms and tops, and how to use the information to forecast future price action. Now, all of this sounds very complicated. And Gann Fans, like I said, if you want to understand the concept of Gann Fans, you want to understand how the mathematics work at Gann Fans, it is complicated. But once you've learned how to put the Gann Fans on a chart and take all that mumbo jumbo away and just think about them, that they are support and resistance lines out into the future, you can easily trade from them without technically understanding all the ins and outs of the past, the present, and the future. Because a Gann angle is a diagonal line that moves at a uniform rate of speed. Okay? Can you understand what that means? A trend line is created by connecting bottoms to bottoms in the case of an uptrend or tops to tops in the case of a downtrend. So in other words, when you're going to form a Gann Fan, you want to start with your first angle connecting the top to the top of a uptrend, or it's a bottom to a bottom of a downtrend, because you have to put the first angle on correctly. The benefit of drawing a Gann angle compared to a trend line is that it moves at a uniform rate of speed. This allows the analyst to forecast where price is going to be on a particular date in the future. Sure it does. This is not to say a Gann angle always predicts where the market will be, but the analyst will know where the Gann angle will be, which will help gauge the strength and the direction of a trend. A trend line, on the other hand, does have some predictive values, but because of the constant adjustment that usually takes place, it's unreliable for making long-term forecasts. Okay, you guys are writing in lots of questions. I guarantee you, if you sit back and let me go in the order I've built this class, we'll answer all of them. So those of you guys saying, can you show us how to put it on the chart? I will when we get ready for that. So just sit back and relax, and I'll get to it because I spent hours building these classes, actually weeks building these classes. And believe me, they answer all of your questions in a sensible order. Okay. As mentioned earlier, the key concept to grasp when working with Gann angles is that the past, the present, and the future all exist at the same time on the angle. That being said, a Gann angle can be used to forecast support and resistance, strength and direction, and the timing of tops and bottoms. Now, using a Gann angle to forecast support and resistance is probably the most popular way they are used. Once the analyst determines the time period he or she is going to trade, monthly, weekly, or daily. So the first thing you want to do is you want to get your chart out based on the time frame in which you trade. Now, the nice thing about Gann Fans is you can use multiple Gann Fans in different time frames and overlay them. But the first thing you want to do is take your decision. What type of chart and what type of strategy are you using? Are you a day trader? Are you a swing trader? Are you a long-term investor? If you're a day trader, you're using 15 or 30-minute charts. If you're a swing trader, you're probably using 1 hour to daily chart because you want to see the price movements moving future. Because a day trader wants to be out of the markets within the day or not too many days later, where swing traders looking for 6 weeks, 8 weeks, 3 months staying in the market. Where an investor could be looking at a very long time. So what you want to do is first get whatever chart you use for your trading strategy. Okay. Then once you have that and properly scale the chart, the trader simply draws 3 main Gann angles. They are a 1-2, a 1-1, and a 2-1. Okay, now you're saying, what is all that mess? From the tops and the bottoms. This technique frames the market, allowing the analyst to read the movement of the markets inside. Now, Gann Fans are based on a theory developed by Gann using 45-degree angles. And these angles also move with the speed of the market or using time frames. So they used to be very complicated. The mathematical calculations of putting them on charts was very time-consuming and outright complicated. So most traders didn't use them at all. Okay, Gann theory had a lot of value in the market, but unless you had computers and computerized charts or slide rules and were really good and adapt this, you didn't use them. Like I said, back in the days when I started trading and we were doing hand charting, it was just too much time-consuming. So we would use other ways. Even Fibonacci levels, which have become very popular, is because they've become easy to put on charts using the new computerized charts from whether you're using Java charts or HTML charts. So you don't have to know how to do the calculations. And that's an important thing because the calculations are quite involved. But traders should note that the market rotates from angle to angle. This is known as the rule of angles. This rule states that when the market breaks one angle, it will most likely move to the next one. So Gann is a set of angles starting at a 45-degree angle using the price of the last top or bottom of the market. So if you're looking at a downtrend, you find the swing high. If you're looking at that it currently ended, so if you just ended a downtrend, you would then look for the swing low. Okay. So let's go over and put a Gann fan actually on the chart. Okay, because you're going to see that all the charting services are different, but they all kind of are equally the same in how do you put Gann Fans on. Okay. You have to locate on the charts that you're using a button or a tool that allow you to put Gann Fans on here. So here we can find Gann Fans under all of our fancy types of indicators, and we click on Gann Fans. Now what we have to do is we have to locate the asset and determine whether it's in not where it is currently. Did it just finish, or has it completed a downtrend, or has it completed an uptrend? Okay. Now we can see the euro right now is trading in an uptrend, so that has not been completed. So what we're going to look for is the swing high and the swing low. Actually, we're going to look. So we have a swing low down here for the beginning of the uptrend. So we want to look for the previous downtrend. which would be located right here where the swing high is. And then our Gann fans are put on a 45-degree angle. Okay, let me just, I'm not putting them on right. I want to show you something, and then I'm going to go move them. Okay. See these ribs of the fans? These are the support and resistance. This one right here, and I've just colorized this. Okay, you can use your indicators in colors, rainbow colors, solid color, because we're not concerned with the in-between of the fans. We're concerned with the support and resistance line. This main center one is called the 1-1. That is the line that is dropped on your chart at a 45-degree angle from the price. Okay, so let me turn this off and let me pull this off again. I'm going to take this one off, and what we're going to do is, and I'm just going to eyeball the 45-degree angle. Okay, now, okay, how do you get a 45-degree angle? Okay, well, if you know that this is a 90-degree angle, where's 45? 45 would be there. And we put this 1-1 rib on. This is the price at the one time frame. And then the rest of it is dropped on automatically for you. You pull it forward on this rib, and the rest of these are already calculated for you. And this is called the 1-1. Then we have the 2-1 and the 1-2. We have the 4-1 and the 1-4. Each of these are different angles. Once you've drawn them on, the Gann fan goes forward as far as you want it to go. Now, we can see that this Gann fan has very little to do with the current price here, okay, because the price has moved above where there was the top of the previous trend. But if you look at how when we laid this on here, when the price moved and broke this uptrend and went to the downtrend, look at all of these prices that had significant action and reaction to these ribs. So these are support and resistance lines that are, again, the colors in between are insignificant. It is the lines. So let's go back and learn what these 1-1s are and what these 1-2s are and these 2-1s, and then we're going to go back and put one on another Gann fan on the chart, because then we're going to do what we call squaring. And you can have many Gann fans overlapping each other. And the more that they overlap and square off these price ranges, the more important that price range is. Okay. So let's go back and talk a little bit more about what these individual fans are. Okay. So finally, Gann angles are used to forecast important tops and bottoms and changes in trends. This is a mathematical technique known as squaring, which is used to determine time zones and when the market will likely change direction. The basic concept is to expect a change in direction when the market has reached an equal unit of time and price up or down. This timing indicator works better on longer-term charts, usually on monthly or weekly charts. This is because the daily chart often has too many tops and bottoms and ranges to analyze. Like price action, these timing tools tend to work better when clustered with other time indicators. Okay, now Gann fans do not work well on their own. They work exceptionally good with Fibonacci levels. So as you can see on this chart here, we have our Gann fans moving out into the future, and we have our Fibonacci levels dropped on the chart. But let's go back and, okay, to draw the Gann fan, one should select this object and indicate an initial point in the chart. The best way to get the perfect Gann fan 45-degree angle every time is to use the Gann squaring tool. Okay, you don't need to use it because now all the computerized charts do this for you. Once you've overlaid the square onto your chart, open the settings and you'll be sure all are available for the Gann fan levels are visible. then make all of the arcs and the levels not visible. Now each time you drop the fan, the angle will be a perfect 45 degrees without having to be measured. So a properly selected and drawn angle is a form of a moving average, but unlike a moving average, it can project out into the future ahead of the price action on a chart. So what we have is our main one, okay, which is the 1-1 angle. One project in time and the main 45-degree angle. Moving above it, we have half that 45-degree angle. And moving below it, we have half, and then here we would have 3/4. This becomes what's called the 2-1 and the 1-2. Then we go to the 4-1 and the 1-4, and then to the 8-1 and to the 1-8. And these are simply achieved by each time dividing them in half. But you don't have to draw these on. You don't have to, in fact, you don't even have to use them. Most people predominantly use the 1-1, the 1-2, and the 2-1. Most current charting methods now put all of them on the chart for us. So let's go back over to the live charts. So now we have, I don't even know why I have 2 Gann Fans on there. Okay. So we're going to go down to the lowest point down here, the swing low, and put another Gann Fan on here. Well, actually, before I draw it on here, let's put the 45-degree angle on here. So how would you figure a 45-degree angle? Again, that's 90. Half of that is, I can't draw a straight line too well with the drawing tool, but it's about, actually, let's get that off. That's a pretty bad line. It's about somewhere like that. So now we're going to get our Gann Fan. And we're going to take it here, and we're going to pull it up. So we have to pull the blue 1-1 rib along that 45-degree angle. There we go. Now we have our 1-1 on the 45-degree angle, pulling out into the future. Okay. And let me get my markings off of here. And look at all that we see happening right here. When we look at the price where it currently is, remember the assets aren't moving, the markets are closed today. We have our 1-1 line here. Look at all the congestion. We have our support and resistance here, we have our trend line here, and we have price here. So we can expect price to bounce off this level and come up to this resistance level. Look at all of the price action you've had on these fans in prior movements, okay, at these particular support and resistance levels. Again, a Gann Fan doesn't tell you when to make a trade. It doesn't even give you actually entry and exit points. It tries to give you a predictive nature into predicting what price movement or what prices will be important moving out into the future. You have to combine these because this is where you would then want to combine them with things like MACD, okay, to get entry and exit points and trading signals. So it's simply a tool to give you better support and resistance that you might not otherwise see, or to work in conjunction with other support and resistance lines, because the lines, the support and resistance lines from a Gann Fan are much more in tune with the marketplace than a trend line. Okay, and so they can be used, more importantly, to help indicate where trends are going, as opposed to a trend line which can be validated and end very, very quickly. Trading methodology developed by Gann Fans have become very popular tools to help analyze an asset's trajectory. Not to be confused with trend lines, despite giving vital information about trends, a Gann line is a diagonal linear array that is set to measure a specific amount of change in price versus a specific change in time. By using these levels, investors are better able to determine the strength of the trend and when prices exhibit and when prices are expected to hit a certain level. A Gann line is a diagonal linear array that is set to measure a specified amount of change in price and specified change in time. Gann angles are very popular analysis and trading tools that are used to measure key elements. The often debated topic of discussion among technical analysts is that the past, the present, and future all exist on the same line. When analyzing or trading the course of a particular market, the analyst or trader tries to get an idea of where the market has been, where it is in relationship to the former bottom or top, and how to use the information to predict future price action. Now, many traders still draw them on charts manually and even use a computerized technical analysis package to place them on screens. Because of the relative ease traders today have of placing Gann Fans charts, many traders do not feel the need to actually explore when and how and why to use them. The angles are often compared to trend lines, but many people are unaware that they are not the same thing. A Gann angle is a diagonal line that moves at a uniform rate of speed. The benefit of drawing a Gann angle compared to a trend line is that it moves at a uniform rate of speed. This allows the analyst to forecast where a price is going to be at a particular date in the future. This is not to say that a Gann angle always predicts where the market will be, but the analyst will know where the Gann angle will be, which will help gauge the strength and direction of the trend. A trend line, on the other hand, does not have a predictive value, but because of the constant adjustments that usually take place, it's unreliable for making long-term forecasts. As mentioned earlier, the key concept to grasp when working with Gann angles is that the past, the present, and the future all exist on the same angles. This being said, the Gann angle can be used to forecast support and resistance, strength of direction, and when timing of tops and bottoms. The Gann lines are commonly employed technical to discover where potential support and resistance levels lie on the three main angles defined, the 1-2, the 1-1, and the 2-1, from the tops and the bottoms during specified periods of time. The first and the most important line is the 1-1, or the 45-degree angle. This line basically is used to represent a 1-point change over a one measured period of time, usually a day, as this was traditionally applied to stocks. That's only if when you're talking about time and we're talking about periods of time. If you're trading using a one-day chart, that would be a 1-1 would be a 1 day. If you're using a 15-minute chart, it's a 15-minute time period. It's based on time frame. For the 2-1, it's a 63.75, which represents 2-point change over a one period of time. And for a 1.2, which is a 26, simply, which is each one of those lines divided in half. And that gives you the 1.1, the 1-1, and the 1-2. Like I said, they go all the way up to 1/8, but very few people use them that far. So the significant ones are the 1-1, the 1-2, and the 2-1. Okay. Now, fans are typically established at highs or lows in the price action after the onset of a reversal or a change in trend. Okay, this is the most important part. It's finding out where to start your Gann. The idea is that it defines the past, present, and I'm tired of saying this, future action. Additionally, when both upward and downward fans are combined at levels that define highs and lows over a time period is a process known as squaring. It helps to understand potential times when asset prices may shift. However, this is a more complicated strategy that is used for longer-term charts. Using a Gann angle to forecast support and resistance is probably the most popular way they are used. Once the analyst determines the time he or she is going to trade and properly scales the chart, the traders simply draw the three main lines from the top to the bottom, and this technique frames the market, allowing the analyst to read the movement of the markets. When applying this indicator to a trading strategy, the Gann Fan can be especially useful for defining potential entry and exit points. However, the first task is to understand just how bearish or bullish an asset's momentum is. Gann lines that are trending upward are typically used to denote support, whereas Gann lines that are trending lower represent potential resistance. Once one Gann line is broken, the next line becomes the relevant level for price trends. Another way to determine the support and resistance is to combine angles and horizontal lines. For example, often a downtrending Gann angle will cross a 50% retracement level. This combination will then set up a key resistance point. The same can be said for uptrending angles at 50%. And this is why they work very, very well with Fibonacci. Okay. And it's a great combination. Price scale and timing can vary widely based on volatility of the underlying asset being traded. Therefore, the time scales that a trader is using the Gann Fan applies to stocks may not be the same characteristics as those used for commodities and currencies, meaning the indicator's input should be fine-tuned for each asset class it tends to apply to. Now tonight we've been talking about, this afternoon, we've been talking about the Forex market. So we're pretty well with that. But Gann Fans combined with candlesticks turn into a great trading system, because then you have your candlesticks telling you what's happening in the market and giving you the indications, and we have the Gann Fans working as our entry and exit points. So as we can see, here we have our Gann Fan on the charts, and we have our 50% retracement levels drawn on there, and you can see how the price reacted at the 50% retracement level. Okay. So they work very well in this combination. Finally, Gann angles can also be used to forecast important tops or bottoms of changes in trend. Now, when we drop two different Gann Fans from two trend lines on top of one another, so we have one Gann Fan used coming down from the swing high, and then a more recent one from a swing low, and they overlap each other. These areas where they overlap become squaring areas. In this one, we've also added Fibonacci levels on here, so we can see all that's happening with the price. So we have our Fibonacci levels on here and our two Gann Fans that are squared off. Now, Gann angles can be a valuable tool to an analyst or trader if used properly. Having an open mind and grasping the key concept that the past, the present, and future all exist at the same time on a Gann angle can help you analyze and trade a market with more accuracy. Learning the characteristics of the different markets in regards to volatility, price scale, and how markets move within a typical Gann framework will help you improve your analytic skills. So hopefully we gave you a little bit to think about tonight. Gann Fans are a complicated indicator. Once you've mastered them, you've got a great trading tool. But there's no way in a 1-hour class that you will learn how to use this. There is great reading literature all throughout the internet. Don't look for the strategies, just look for the applications. Okay? And then put them on your charts and follow the steps. Okay? There's all kinds of gurus out there trying to tell you how to use them for strategies. First, learn how to apply them, put them on charts, and see them. Understand squaring, and then slowly learn, because it's going to take you many days of reading and practicing to get these. It's one of the indicators that is more complicated than the standard ones. So learn them, and then you'll find out, because there's very few that have a predictive nature that help you see where price will be going and that don't end when a trend ends. So read about them, learn them, and then come back and try them. Thank you very much for joining us tonight, and thank you for being part of the ETX family. Have a good evening now.